This episode is proudly sponsored by ShakePay, Canada's easiest way to buy and earn Bitcoin in 10 minutes or less with no deposit or withdrawal fees. It's so easy, even the boomer can do it. Guys, I've personally been using ShakePay for several years and highly recommend them. Their mobile app makes it super easy to buy and sell Bitcoin. All you have to do is e-transfer directly to your ShakePay account and you're ready to go. So head over to shakepay.com or download the mobile app, use the referral code Loonie Hour and get $30 of free Bitcoin when you sign up. ShakePay gives out free Bitcoin to every user every day just by shaking your phone. They call this the shaking sats feature. It's awesome. I highly encourage you to go check it out. ShakePay has also just launched one of Canada's only Bitcoin cashback prepaid credit cards, which gives users up to 2% Bitcoin cashback on every transaction. If you want to opt out of Canadian dollars and start earning rewards through Bitcoin, go check out ShakePay. Once again, guys, that's shakepay.com. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 45. As always, joined by the three amigos. We got Keith Dicker of IceCap Asset Management wearing his red hot chili peppers shirt. And we got Rich Diaz, the Tom Brady of macro, of Acorn Macro Consulting, pounding drinks for this week's episode. Welcome back to the show, gentlemen. What's going on? What's the latest in Montreal? Rich?
Well, I'm wearing my Thomas Sowell shirt. He's an economist from the University of Chicago. I recommend everybody look him up. He's got great YouTube videos.
You know, you run a macro podcast when, eh?
Yeah, when you wear t-shirts of your favorite economists. Yeah, he's brilliant. I've read a couple of his books. He's definitely someone who challenges the views of what we might be force-fed.
So,
and,
like the Loonie
I would
Hour,
recommend
then.
him. Yeah, no, I think he'd approve of the Loonie Hour. I think he'd approve of the Loonie Hour. He's still alive. He's old.
Get him
but he's
on.
still alive. I'm not sure I can do that. I'm not that
Keith,
kind of pull.
Keith probably knows it. Keith probably went to the same high school as him. Hey, Keith?
Well, we did. Well, you know what? Like, we did hang out at Woodstock together for a few hours. That was fun.
Apparently that's a big movie on Netflix. I haven't seen it yet, but Rich, have you? I know Keith hasn't.
Not interested in that.
Okay, well, there you
Sorry.
Wait, whoa. What's this Netflix?
go. It's this thing that you gotta stream and pay for a subscription.
It's internet on computers. Anyways, let's talk about the markets.
Wait. I got one thing. I need to apologize to Rich for something.
Uh-oh.
So last week you made a comment, and I sort of came back and I said, "Well, that's not quite right," because you talked about the bike paths in Halifax is, you know, just for the wealthy, stuff like that. They weren't used. Well, I was out on the bike path a couple of days ago, and you're right. I was probably the only one on it, but I was going down.
He's
the bike
driving
path.
his Range Rover down the bike path.
Yeah, and I see something right in the middle, so I stop. I pick it up. This is what it is.
Patagucci. That's hilarious.
So for those that are listening to this, it's a Patagonia hat. So we talk about Patagucci all the time. So I found like an $85 Patagonia hat on the Halifax bike path. It was probably lying there for days. I'm the only
That's a
one
really
that
nice
used it.
hat.
Hey, thanks, man.
My wife just got me a new Patagucci sweater. Fun story. The color that I wanted has been out of stock for 12 months. It's finally back. So the supply chains are easing. That's the good news.
Well, as far as riveting podcast stories go, I have one more, and then we'll carry on. Which is, I was at a baseball game in Toronto over the weekend, and the hot dog vendor Dino recognized me, and he said, "Hey, you're the Loonie guy." And I said, "Yeah, I am the Loonie guy." I'm like, "Nice to meet you. My name's Richard." He's like, "I know who you are." So Dino, if you're listening, thank you very much for your support and your encouragement, and your hot dogs are fantastic. So there you go.
Dino, the hot dog guys, end up on the bingo chart.
Yeah. True
No,
story.
That's
love it.
outstanding.
That reminds me, as always, guys, we do appreciate your support. All we ask that you continue to share this podcast with at least one friend or family member and help us push past Arrive Canada. I was doing some more research on that, and it turns out that they actually had more reviews than Twitter and Facebook. So
Combined or just alone?
not combined, but like they dwarfed like Twitter's reviews.
Yikes. Okay.
Which kind of concerns me. Anyways, let's get into it. As always, let's open this thing up. A lot of Canadian content this week, a lot of data points coming out. But of course, we'll always go around the world here, but I think we start things off here with a lot of the Canadian housing data as we've been tracking that. So we had the national housing statistics coming out for the month of July. National home sales fell 5.3% on a month-over-month basis, but so the one that you should probably look at is actual activity. So when you're comparing July sales versus last year, down 29% from last year. And more importantly, what everyone's kind of focused on is of course, home prices. So the MLS Home Price Index, which we've talked about before, it's kind of the smooth out lagging index. It declined 1.7% month over month. So, if you start annualizing that, that's a pretty steep decline. And in fact, we're actually now down. So per the index, prices nationally peaked in March, and we're now down 9% from the peak. And so if you actually go back, the home price index was actually created and it was launched in 2005. And so of all the data series that we have going back to 2005, this is actually the steepest price decline. That's the largest sell-off that we've seen, 9%. It actually matches exactly the 2008, 2009 price decline. So as of right now, we are officially in sort of great financial crisis territory in terms of the sell-off of this housing market. And just one more sort of quick stat to hit you with. Like I said, there's many ways to kind of look at this. So that's the home price index. But if you look at the decline in seasonally adjusted average house prices from peak 5 months ago, this is the largest decline since the 1980s. So whether you're using the home price index, which goes back to 2005, or you use the average sales price, which goes back to the 1980s, again, we're only 5 months into this correction. This has basically been the steepest correction since the 80s. So do
you think it keeps going?
I think it's still early. I think the big thing, again, we'll obviously get into it into the show, but housing markets are very inefficient. A lot of emotional sellers you're dealing with, particularly it's all retail, right? It's all residential. You're not dealing with Wall Street here. And so these price declines tend to be a little bit choppy. But I think the big thing is so long as rates stay basically where they're at, which is 5-year fixed rates, basically haven't moved. They're stuck at 5%. And more so moving forward, on September the 7th, the Bank of Canada, which we'll get into, is going to raise rates. We've talked about it last week. I think it's 50 basis points. Your variable rate mortgage is going to go up again, which means your stress test is going to go up again. So I'm having a hard time seeing any positive outcome or any change in the direction of home prices for at least the rest of this year. That's my view.
Can I ask one more question? My sister's on a variable rate mortgage. She's got this sweet condo downtown and she's worried about the reset. Can you tell us about that? Can you sorry, I know.
Yeah.
Sorry, it's a very, very selfish, self-serving question, but
no, it's a really good question because everybody's asking that. It is being made into a larger story than
it should be.
It should be. I mean, I was just chatting with Rob McClister, who's I'd say he's Canada's number one sort of go-to expert on mortgages and whatnot. So he doesn't think it's a big deal today. People have some people will get reset a little bit. They'll get triggered. They have to increase their payments a couple $100 a month potentially. The biggest question is more so if rates actually stay here. I don't think they probably will, but if rates kind of stay at these levels, it's more a question of when these people go to renew in 2, 3, 4, 5 years from now, and there's very little principal that's been paid off, that's where you're going to start to run into these challenges. So that's kind of what we're keeping.
But I can tell my sister that she's going to have to pay a couple $100 more, basically, if she gets reset.
I would just like plan for that. But like there's different programs. Every bank's going to be a little bit different. We mentioned on the show before, but like RBC, for example, is only asking that they're going to increase your principal payment by $2, basically, because that makes them compliant with the banking regulator. That there is principal being paid off but I think if you're a prudent borrower, you should probably just arbitrarily increase your payments. Go to your bank and say, hey, I want to increase my monthly mortgage by $200.
Okay.
Because what happens is the amortization base becomes like what started as a 30-year amortization for some people is now looking at a 40 or 45 or 50-year amortization because there's very little principal being paid down.
I have a question for you guys with the housing market. The euphoria, I call it the euphoria because that's what it was in my mind.
Yeah.
Last year, especially in the first half of this year. Was it mostly people just buying a home, or were people actually doing in buying multiple properties and as investments? Because the risk here is that all of a sudden they are getting underwater, and then they have to start trying to, deleverage in a falling market. Whereas people who bought it as a home, they're going to work it out, right?
Yeah. I would say predominantly end user. Like basically what it was, like if you think about like the pandemic, right? It was, oh my gosh, the job that I used to have to go to the office for 5 days a week has changed. Now it's hybrid and I'm locked in my house. Like everybody just wanted like a change. They needed like a change of scenery, whether it was renting Airbnbs on like these cool little islands or what have you. Like people wanted to move. They wanted more space. They wanted a backyard. So that's why like the suburbs, obviously, suburbs went absolutely nuts. The price valuations were utterly insane. And it's like, even if rates stayed at 2%, the suburbs were coming down regardless. This has just exacerbated the pace of the decline. But I would say it's predominantly end users. But now don't get me wrong, people that have made a lot of equity in their housing over the last 2-3 years have definitely taken a portion of those gains and doubled down on the property market through an investment property. So I do think there's going to be a little bit of pain there. I do think that the investors tend to be more on variable mortgages. So they're going to be impacted by some of that. With that being said, the one silver lining, if you're an investor, is the rental market is completely bananas. Rich, you actually had a chart on the CPI inflation.
Yeah, I think we're going to touch on the inflation print a little later, but I just have before we get to that, if it's okay, I just have a cynical view or a cynical answer to Keith's question. So Keith, you'll be proud of me for being so cynical. I think it's, to answer Keith's question, I think it's, fool me once, shame on you, fool me twice, you just can't get fooled again. Anyways, the issue, I think what in 2008, when they decreased interest rates, they printed all this money. I think a lot of people, mom and pops were caught off guard, and they didn't appreciate and take advantage of the asset price appreciation, the asset inflation. And I think over the COVID thing, I think a lot of people did not get fooled again, to quote George Bush. I think a lot of people saw the writing on the wall when the interest rates got smoked. And the QE came and the Bank of Canada bought 87% of bond issuance. And I think a lot of people, as soon as that started to happen, they knew exactly where to go and what to do. And so I credit the people who actually took advantage of the absolutely terrible central bank decision making and bought in and pushed that trade and took advantage of that trade. I didn't. I wasn't smart enough, but I think that it's a balance. I think it's what Steve sort of outlined, which is people who were interested in obviously having a bigger home and that space, et cetera, et cetera. But I also think that there's a lot of people out there who saw the writing on the wall, who lived through the 2008 decline in interest rates and bubble in housing. And then we're like, oh, I've seen this movie before. Let's take advantage. And so I wonder what the split is, but it's not 90-10. I think that there's
Yeah, no, I will say that I said this when they started their QE program and all
Yeah,
this.
you were right on it. You were right on it.
Yeah, but I just said like these guys have created this moral
Hazard.
moral hazard. Thank you. That Canadians have had basically a 25 plus year bull market in housing, and that like every time there's been like a little wiggle, that the policymakers have come in and they've propped it up. And so they like, and even in Canada, right, in 2008, 2009, it was like we talked about earlier, roughly 9, 10, 12% decline in house prices. Big deal. We didn't have a US style housing collapse because there was a whole lot of shenanigans behind the closed doors, which many Canadians aren't aware of. And then we got again to the pandemic. It was like, hey, don't worry about it. You can defer your mortgage. We'll buy, all these government bonds to suppress
interest rates will be low for a long time.
yeah, exactly. And so they basically did everything. So there is like this belief there was anyways, there's belief that didn't matter what, that housing was so systemically important that policymakers would automatically come prop it up. And I think now we're starting to see, I think policymakers know it's gone so far that they got to let at least some air out of the bubble here. And now we're going to get an answer here in the next, I think, 6 to 12 months of how far these guys are willing to let it go. I think that's going to be really interesting because I think there are investors that are certainly caught off guard of like, you can lever up to the 9s and there are no repercussions because JT's got my back. So we'll see. But I mean, part of this is going to hinge on inflation. So, I mean, Rich, we had some CPI data from the BOC or StatsCan. I don't know if you want to break that down for everybody here.
Yeah, let's do it. So if you follow me on Twitter, I try, unless I'm on vacation or I'm having a life crisis, I try to show the charts that I think are the most interesting. Headline: stopped rising. So we were a couple of months off, but we're getting closer. This is not because the Central Bank of Canada is amazing or smart or wonderful. It's because of math. It's very, very hard to continue to rise at this level unless you're Turkey or Nigeria or, other countries like that have completely lost the plot. But so, we've got core inflation. There's two types of core. So there's all items ex food and energy. There's core less volatile components and effective indirect taxes. I don't really understand what that means, but they're sort of in the 5 and the 6 range. Something I look at a lot is services. So I'm sure if you guys have listened to me before, you know that services inflation is stickier. Goods inflation is more linked to commodity prices and FX, stuff like that. Services inflation is stickier generally, and that continued to rise 5.6%. Obviously, the components are really important. There are 9 components in the CPI basket that they track. I mean, there's hundreds and hundreds of items, of course, in the CPI basket, but the main 9 components, the things that I really stood out for me were food continues to rise, energy fell, shelter, which you pointed out, Steve, the other day, it fell, which is important. But again, there's different parts of the shelter. There's, owner occupier stuff. There's rental accommodation. There's household operations. Go ahead. Sorry.
The rental accommodation.
So that kept. Yeah,
that, which is good. But I mean, that should be capturing that because the rental market is utterly insane. I mean, there's just so many anecdotal stories that I've got, but yeah, rents are going up. So, but the resale, because the resale prices or whatever, Rich. So shelter is funny that shelter is actually in effect declining now. But
yeah, so remember, shelter is 39% of the core CPI basket. Not exactly sure what it is of the total basket, but for the core CPI basket, shelter in Canada is 39%. That's starting to roll over a bit. So that's really important. Obviously, 39% is a huge chunk, clearly. So that's important. But the rental component, I mean, remember, Canada has the highest immigration levels in 35 years. Like it or love it, hate it or don't. I mean, that matters when you're moving to Canada. You're renting accommodation, and that's important. My favorite chart, of course, is the 3 preferred measures of core inflation, which the Central Bank of Canada in their infinite wisdom, designed and paid for and publishes every single month, and then subsequently ignored. And 2 of the 3 continued to rise. So we're at 5 and 5.4, and then 5.5. And so that, I mean, that's just crazy. And then the thing that I like to look at, of course, is the producer prices X energy. And for me, that was the key thing here, because you have core inflation starting to roll over. So we've discussed this a couple of months ago. We weren't exactly right. You know, when you asked me, I think you said, Rich, when do you think it's going to start to roll over? I said, you know, I said June. I was wrong. You know, these charts are never perfect. I mean, who knows what will happen going forward, but I think we're starting to reach sort of the upper limit of these core inflation numbers, because producer prices, core producer prices are falling. And so expect the Bank of Canada to start taking credit for lower inflation very soon.
Yeah, I've got a question, and I'm sure we'll get into this. I'm sure Keith's going to chime in here as well. But because a lot of like the pushback, it's funny because I think people are like a dog on a bone with this like inflation trade and narrative. I almost think it kind of definitely factors in with like your political views and whatnot. Let's be honest.
Of course.
That there's like, oh, well, this inflation is only going down because energy prices and oil is coming down. And this is just a temporary thing. Wait till the winter comes around and Europe's freezing in the cold and energy prices are going to rip through the roof and all hell is going to break loose. How are you interpreting this?
I mean, yes, in truth, it is. I mean, Canada is one of the largest producers of oil in the world. We don't refine anywhere near enough oil. And so our terms of trade is at the mercy of the oil price, more so than it should be, let's say. But energy component, which is one of the 9, which I referenced earlier, has come off. It's still 28% year on year, by the way, but it's come off from 40%. So yeah, you're going to start to getting a slowing of that price. And, you know, the problem with a lot of these narratives is it's just never one thing. It's stupid to say that it's Russia's fault. And it's stupid to say that it's, you know, just the government's spending or just the central bank liquidity. It's usually a function of all of the above, which is boring. You know, you don't get Twitter follows for being nuanced. I think that's the point. I think, you know, you're having a slowing in energy prices. You're having a slowing in transportation. What matters to me is food, because food is a larger portion of working class people's budget. What matters also to me is shelter, and that's starting to slow. But I mean, it's a boring answer, but I think it's the truth. It's a little bit of all these. It's, you know, a little bit of column A and a little bit of column B, and you know, that's unfortunately that's my view.
Keith, what's your takeaway from all this?
I forget the question by now. What do you? Good old Keith, eh? So, you know, one thing I love about Rich, you're very bottom up. You have all the data, and you know, for us, we're very top down, and you always need a combination or marriage of both of them, because it keeps each one in check. So, like, to give you an idea of the way we look at things right now, we're looking at, you know, the economy on one hand, then you're looking at inflation data on the other hand. And then you're looking at what, you know, central banks are saying on, if they have another hand. You have 3 hands, maybe. But what we're seeing is that the inflation data, it's like some places is still increasing. Like the European data came out this morning, and month over month is still going up. And
UK hit 10%.
I think they were 8 something. Sorry,
wasn't it 10? Rich? UK?
Oh, I sorry, I don't know. We'll have to look at it. But anyways, so it doesn't matter. It's high. It's high. That's
yeah. So inflation is still high everywhere. That's the point. You know, of course, you guys, I know my view by now. I think we are headed into a period where economies around the world, they do have a high probability of giving a pretty big unexpected thump. And that doesn't mean it's a 100% probability, but it's a lot higher today than it was a month ago, and then 2 and 3 months ago, you know, before that. Again, just to reset here, inflation data is still high, but we can always make the case that it's not increasing as fast as it was before.
Right.
So therefore, everyone's getting a bit dovish. And what we mean by that is maybe the central banks won't raise rates as much as before. And so that's happening with the Canadians, the Americans, of course, and so forth. And then I mentioned on the economic side, data, it is looking like, so specifically, like if you look at different regional ISM data points in the US, so showing regional manufacturing activity. And Rich has always provided some great data on this. You can break it down to services and as well as manufacturing and prices paid and all that stuff. But it's clearly showing, something is happening underfoot. And that's creating this key moment right now in markets. And we haven't had a key moment now for a while. But what that moment is, everyone's talking about this pivot. And what the pivot is, will the central banks stop raising rates or not raise rates as strong as they were before, or even start cutting rates? And everyone's talking about it. And every day the markets are sort of, teetering back and forth on what's going to happen. But what has happened over the last few days and in the week, even though inflation is not growing as strong as it was before, and economic data is getting softer, I'm seeing and hearing that the central bankers are saying, you know what, we're still going to raise rates. So of course, it brings us to the Bank of Canada story. Maybe Steve can jump into that. So when we look at all this, and I think we mentioned it on the last week's episode, where we're getting this big gap between what the market is now expecting for year-end central bank rates towards what the central bankers are telling us they're going to do. And so coming up now in a couple of weeks, like we're almost there. So on September the 7th, we have the Canadians coming out. On the 8th, it's the Europeans. The Fed is September 21st. So we're going to get a lot of fireworks in markets as we get closer to those dates coming up. So that's what we're looking at here. So like right now we're in this, sort of sleepy August period where all the data has come out. But, we're all sort of getting ready for, some red hot chili pepper type action.
Sleepy August.
Can I add a couple things? There's just 2 points. One is I think so I agree with Keith. There's two things that I think people need to understand. Number one is CPI is always backward looking. And I think it's important that when we reference these numbers, 7, 8, whatever the numbers are, you can believe them, you can hate them, whatever you want. We have to, like, whether you have a model to do so or whether you just sort of infer, it's not so much important what's going on today. It's what you think might happen over the next 3 to 6 months. So that's the first thing on the CPI. And that's what maybe we don't stress that enough. We always just say the exact number. The other thing is that Keith just threw in this word regional Fed. And for some people who may not know, is that the US Federal Reserve, we always talk about the Fed. There's no such thing as really the Fed. It's really actually 12 branches of the Fed. And so, there's 12. I can't remember all of them. There's San Francisco, Kansas, New York, Dallas, Richmond, Minnesota. Oh, I screwed up. Texas, Dallas. Anyways, whatever. So there's 12 branches, and the Fed.
Dillon, Texas is pretty big.
Yeah, exactly. There's one in Memphis, I think. Anyways, whatever. There's 12 of them, and what they do is they all act as regulators. They lend, their lender as last resorts. They provide liquidity. They issue notes, like literally bank notes. They are payment clearers. So if you're a company X and you're buying from company Y and you're literally giving them $12 million, you might go to Chase or Citigroup or whatever, but at the end of the day, those payments are cleared through the Federal Reserve. Anyway, and what Keith was referencing is each of those regional branches will have indicators. And a lot of those indicators are rolling over like crazy. So the ones that I noticed were New York, Dallas, and Philly that have rolled over like wildly, very negative. And some people amalgamate those and then say, the US is the ISM is going to follow suit. Who knows? But anyways, just to give some kind of light as to when Keith says regional Fed, that's sort of what he means. Sorry. I thought that was an important sort of.
Yeah. What people may not realize as well, like a long time ago when I was a little boy back pre-Great Depression.
Before the internet.
Yeah, well, long before the internet. But the reason there were Federal Reserve banks is because, money capital wasn't flowing electronically and things like that around the country. So that's why you had, the West was growing at a different rate than what the East was and the South was and the Midwest and all that. So that's why you had these different Federal Reserve banks, basically, think of it in that aspect. And they all had different rates. They had different interest rates. And you might think, do you guys remember the show Seinfeld years ago?
Mm-hmm.
So remember when Kramer and what was his buddy's name? Newman. They were going to try to collect the empties and try to put them in a truck and go up to one of the other states, get a higher refund on it than they could. But there was an arbitrage, and that arbitrage didn't exist back then with the Fed, because you couldn't put your horse and buggy filled with cash and try to hightail it from San Francisco to Chicago, because you weren't going to make it.
You die of dysentery.
Yeah, you get like a bullet or an arrow in the head on the way. But all that changed over time. Another thing people may not realize as well, one of the main differences between America and Canada is in Canada, a lot of the power is held at the federal government level at Ottawa. But the United States is different. It really is a union of 50 states. And the states have a lot more power than the federal government in a lot of spaces. That's sort of a bit of the, very exciting Federal Reserve story. Maybe we can go back now and talk about the diffusion index from.
Oh man, I'm so much.
That.
By the way, lots of people ask in the comments about books we should read. Check out Lords of Finance.
I have that. I haven't read it. I got it.
Very boring,
but it's like
very
500
boring
pages
and very long. It's very boring and very long, but it'll tell you a lot about the Great Depression. It'll explain the central banks. It'll explain France, England. It's a really cool book if you're a nerd.
Maybe I should read that on my trip.
Guys, one other
asleep.
The other interesting thing that's really happening now is again, our view. We think the world is really starting to struggle economically from the outside coming in. But what I mean by that is the emerging market countries first, and then it's creeping into the Western world, and America will be the last one. I don't think the Americans will experience a sharp of a slowdown as what everyone else is doing. If they do, boy, it's going to be a real struggle for everyone. But like over the last couple of days, the Chinese, they cut rates domestically. And really people say, yeah, well, they're doing a lot of things, right? They had to expand or increase decrease their the commercial bank reserve requirements. So that's adding liquidity to the system. Now they just cut rates. So like the Chinese are really struggling with this local housing, real estate developer banking crisis, because that's what it's turning into. So we have that happening. And then this morning we had Turkey, and, as God is my witness, Turkey is not flying right now. I think they're no, I was my favorite TV show.
That's
I like those. Yeah. I really identify with Les for some reason.
The turkey.
Steve is like, what the hell are you talking about?
The turkey story is back on the table.
It's coming back. But, they have inflation running at 80% plus on an annualized basis. And this morning, out of the blue, they cut rates. And so Turkey is really struggling. Like the Chinese, they don't have US dollars coming in or as much as they had before. I think Turkey didn't they just make a deal with the Russians for oil? Did we get paid in rubles or something like that?
Probably. Turkey has no oil, so they need it.
Yeah, absolutely, they need it, and they can definitely get access.
Unless they invade the Greek islands and
they got wind turbines.
Every morning I get I'm on a DM group with one of my Greek friends, and Steve, you
Michael
spoke with him there, yeah. And you should see him getting fired up this morning with Turkey. And by the way, he always sends me a photo of his Greek island that he's on, for the week and stuff like that.
But Keith, there's more than just the housing in China. I was looking at industrial production for semiconductors and integrated circuits. There's also imports and manufacturing and machinery equipment, and both of those are negative 14 and 20% respectively.
What about the collapse in China's producer prices as well?
There's something going wrong in China. I don't quite have a feel for it. I don't have a beat on it quite yet. We've talked a lot about the real estate market. That's well understood. There's something going wrong there. But it's more than just that. I mean, if you look at industrial production, like I just mentioned a second ago, semiconductors, machinery, equipment, imports, there's something going on, and it's not good.
They're in trouble because, again, this is a Canadian show, and but the reason we talk about this is because if this really escalates in China, for example, it's absolutely going to affect us here in Canada. We have to realize that it will happen. But like one of the other main things with China is what's happening with the currencies in Korea and Japan. So, the natural relief valve for everyone is your currency. That's where you can let stress or risk get reflected. But the Chinese, they don't allow that because they have a closed capital account and their currency is pegged, and same thing in Hong Kong. Like, they're really struggling. And so right now they're losing market share in the region. And if they floated their currency, it would drop like a stone. If they try to weaken it aggressively, they try to take market share back against the Japanese and the Koreans, then that's going to take off the local guys. That's going to cause even more capital to leave. So they're in a real tough spot here. And the reason it's a tough spot is because of the banking system. It's just so levered, and it's really stuck with bad debt in the system. And that's why Europe is this economic fantasy land. And I joke about that all the time. But it's not a joke. It's fact. It's reality meets fantasy. It's the same thing. But the main challenge with the Europeans is that they weren't able to write off all this bad debt in their banking system, and that's legacy from the 08-09 crisis. Whereas the Americans did. They did that. But so now we have the European banking system is deadish. The Japanese have their problems with their yield curve and debt, and China is going down that road as well. So the opportunity set here is that, if it does increase, the US dollar will go really strong. Canadian dollar will come off. I do suspect Canadian dollar will be really strong on a cross basis. So anyone going to Europe, I think they'll do okay with that. And then, the Japanese and Chinese against CAD is not going to look very good. But
so that's something I think we should differentiate, because sometimes we say like the Canadian dollar is going to weaken, and it has versus the US dollar, but it's at a, what was it? 8-year or 9-year high?
8-year high against the euro.
8-year high versus the euro. The Canadian dollar is doing really, really well, except against the US dollar, so it's just important. Sometimes we sort of gloss over that.
Get your euro trips in now before the Canadian dollar.
There's your travel advice, everybody.
before housing takes it down.
That's right.
Another little point. I don't know if anyone follows this guy on Twitter, Craig Fuller. So he's the founder, CEO of FreightWaves, basically like American shipping and transportation.
Okay, cool.
So he says container rates. Remember when everyone was talking about container prices, shipping from overseas, and obviously that ultimately gets passed through onto the consumer and inflation. So container rates from China to the U.S. West Coast, he says should be down. He believes that right now they should fall to about $3,900 by November. That'll be off more than 80%. From peak. They peaked at about $20,000, and he's got them going to 39. They're currently at about $5,800 right now. So I don't know. I think there's something smells like disinflation to me. And
wait a second. I mean, I'm not fully disagreeing with you, but it's also we understand how to ship things across the ocean, right? It's partly a disinflation impulse, which I respect, and I can appreciate that argument. It's also partly things getting back to normal. Makes sense, right?
Well, exactly. And I still think you guys tell me. I mean, my sort of thought process is to me, it doesn't feel like it's a demand pull inflation. it doesn't feel like demand is so red ripping hot that's the reason for like, okay, so UK inflation, by the way, was 10.1%.
Yeah, that's right.
So is UK inflation really like, oh my God, there's just so many people and everybody's just got this massive demand that's like, or is it more like an energy story / we're fixing these supply chains that have been obliterated over the past several years? Like we closed the global economy for months.
Can I play this game? Can I play?
I have a view on this. Go, Keith. You go,
Keith.
Keith. I have a view on this. Go.
I mean, it's a bit of both. I mean,
yeah.
Again, like for the rest of our lives, we're always going to look back and realize for better or worse, or right or wrong. Yeah, absolutely. Locking down the global economy, it turns out it's not a good idea. And, people, that's not true and all that stuff. However, we may never get the global economy and global supply chains back online again. Like globalization, it's now dead. Nationalism is coming back. And so it's really hard to get stuff pushed through. And so one part to answer your question, Steve, supplies are tough. I think I read an article yesterday. They're saying that if the Chinese do blockade Taiwan, I forget for how long it would have been, but it was going to, for example, if you want to get a new Apple computer, for example, like you're now looking at like months and years to get this thing put together. So shutting down the global supply chains, yeah, absolutely. But then it's had this sort of like boomerang effect. People are sitting at home, they're getting paid to work or not work. And of course, which increased, services and everything. So I think, because of the way numbers are calculated, the maths are going to show us as we get into 2023, some of these year-over-year numbers are going to start to average out again, and inflation will seem not as challenging as before.
Right.
But we're still going to be up at this crazy level from what it was back in 2019.
Yeah, exactly. But is it not like flipping back? Like, Rich, you can see it now, right? Like in the service, now that the economy is like basically reopened and everyone's like, oh my God, I'm going to go traveling again. Like service sector inflation is obviously ripping up. And then consumer goods prices, for a lot of the crap that you were buying during the pandemic, like look at all the overstock that Walmart and Target and everybody are sitting on. They're having to reduce their prices because people aren't sitting in their houses ordering crap on Amazon anymore. That it's now the inflation is that's getting repaired. They're now like overstocked. And the pent up demand is basically going back into, people going out and living their lives, and that's pushing service side. So like to me, it's just like the whole world got completely obliterated over the last 3 years, and we're like muddling through this now, trying to fix everything.
Well, that's what I was just going to say. I was going to say, again, the right answer is probably the boring, nuanced answer, which is it's a little bit of column A and a little bit of column B, to quote Abraham Simpson. You know what I mean? Like it's at first it was definitely demand pull. You give everybody shitloads of money, they all stay home, they all order crap off Amazon, and then that goes away and everybody goes outside, and instead of buying goods, they're buying services. So one of the things that we got the retail sales number that came out today. I think it was okay for the US, but I think we should sort of ignore that. I think what we should be spending a lot of time thinking about is forget what you're buying as far as goods. Now it's all about, in my view, services. So how do we look at that? We look at personal consumption expenditure. In the US, they split it into two, services and goods, and then you break it out. In Canada, they do the same. In the UK, they do the same. In China, do the same. And you can see that services expenditures continues to rise in real terms, and goods expenditures is muddling along, and it makes sense. When you were stuck at home, you bought, I don't know, pineapples and PlayStations and party hats or whatever. I was trying to alliterate.
I was like, pineapples.
Whoa. So during the pandemic,
I didn't buy any pineapples.
No, I was making a point there. Now you're doing services, you're traveling.
Depression?
Now you're doing traveling and stuff, like you're buying services and stuff. And so I think I think the mistake that I think a lot of people make, whether it's mainstream media or strategists on Twitter, it's like it has to boil down to one thing, and it's bogus. It's not linear. It's never just one thing. It's important that we have these discussions to like figure out sort of what's pulling and pushing in different directions.
So I just bought two things on the Amazon. I love gadgets. I love cooking and food and stuff. And every year I buy like new football stuff to put in the room for game day. Mrs. ICAP doesn't know what's showing up soon, which she will when it arrives. But I just recently, this has nothing to do with this discussion, by the way. It's just to do with life improvement. I bought these, the taco holders, like it's like a vertical
A
V.
W.
Yeah, absolutely. And if you're into making tacos, like we love making tacos, and but just prepping them on these taco plates, I don't know what you want to call it. It changes your life. It's so much more fun. It's not this like messy thing that flops around your plate. So that's a good thing to get. And then the other thing which I have coming is I've just recently discovered the Oklahoma onion burger, and I'm getting real good at making and eating them. So I had to get one of these smash burger, like the big steel metal plate that you just smash it down with. But you get that on Amazon, cheap. That's nothing to do with inflation, but it's making my life better.
After this hard sell, there's going to be taco plate inflation coming through.
I know.
And everyone listening to this podcast
me
is now dumber for having heard that. Thank you very much.
But I didn't have to leave my house. I get to stay home all the time.
That reminds me, when's the Loonie Hour barbecue? Everybody's going over to Keith's house.
I don't know, but I will very soon. Yeah, I'll let everyone know. But soon, though, we'll do like a local ice cap drinks at one of the beer gardens here coming up. So
next live Loonie Hour is at Keith's house. Drinks will be provided by Mrs. Ice Cap, and
she will not be pleased.
There's no limit on people.
Like two people might show up. I don't think we have a big village here.
We did briefly post it on Twitter, by the way. This is going a bit off topic, but planning our next live Loonie Hour event in Toronto for December 1st. I think we had it. So if there's any interest there, we'd love to sort of gauge the intent or willingness to meet up with us in Toronto. December 1st is kind of the preliminary date. So if you are interested, obviously comment on the YouTube channel, send us an email, whatever. We'd love to sort of just gauge the numbers. Obviously, last one was a great success in Vancouver, but none of us are in Toronto, so it's a little bit of fresh air or change of scenery. But we'd love to kind of get some feedback on that as well.
Are you wrapping up the show? Because I have one more thing to say.
No, we got another. Jeez, man.
Okay, good. Because Germany is considering keeping their nuclear power plants open. So I just like to say, yeah,
they've been listening to the Loonie Hour.
Yeah, they've been listening to the Loonie Hour. So I mean, it's a long ways away. Yeah, so let's not get excited. They still have to vote in Parliament, and they still need to get Olaf to sign off on it. But there's some rumblings that the Germans are going to turn back their nukes. The UK has a green lit, or I mean, it's again, these things take lots of time to figure out, so let's not get it too excited. But they green lit, I think, like 8 more nuclear power plants. The Japanese have turned it around on that. So there you go. We're making some progress as far as doing some sustainable, renewable, and clean energy. So I'm pretty happy about that one.
I feel like that's like the one like takeaway for me though, is that like I think all three of us on this show are very like cynical. I think we're definitely on the pessimistic side. We're very skeptical of policymakers. But I think like society in general, like we tend to figure it out eventually over time. Eventually we figure it out, and eventually we progress, and eventually we move forward. So it's never really as bad as like it's always as the outlook may always look. I find that we always find a way, but
after we do all the other options, eventually we get to the right answer.
Yeah, exactly. And so our goal obviously on the pod here is to identify the path of least resistance, but policymakers don't always tune in. So
Rich, with Germany, what's the like the runway for this? Is it
so they want to keep the
10 years to get it going?
No,
or
not
what?
even. So they closed 3. They had 6 nuclear power plants open on December 30th of 2021. Then they closed 3 of them because they're idiots. And they were about to close the next 3 by the end of this year. And so what I think that they're starting to do is they're going to keep them open for just a couple more years. I think it's 2024 or 2025. And by the way, it has not been rectified or solidified or whatever language you want to use. It still has to go through Parliament, which is a big ask, because the Greens have a huge influence. And like I said, they're idiots. And then once it goes through Parliament, if it goes through Parliament, it must be signed off by the Chancellor Olaf, I think is his name. In the meantime, they're turning on all of their coal power plants. It's just not all, excuse me, I shouldn't say that. Not all, but a fair number of them. And if they don't do that, they're going to have to cut. I read in the Wall Street Journal, I could be wrong, but I read that they have to cut their energy consumption by 20%. So no country is going to cut their energy consumption by 20%. Just does not happen. So they're going to turn on their coal power plants, or they're going to extend their nuclear power plants, which, by the way, just to be clear, these are not old. These are not derelict. They're closing them prematurely. Yes, just so everybody understands. But they're going to extend them 2 years and whatever. It's a joke. It's such a shame.
So to make it an even bigger joke, last week, the Swiss announced that they're also having an energy crisis, and now they're requesting Germany to export more energy into Switzerland.
But the Swiss have their game. They have loads of hydro, and they have loads of nuclear power plants in Switzerland. So I'm surprised that they did that.
Rich, it was a joke, man.
Oh,
I didn't get it.
The best jokes, Keith, are the ones you have to explain in detail.
I know, but they're asking the Germans for more energy when the Germans don't have it for themselves.
No, I didn't get it. Sorry, those.
Germany's got to get their boots moving, though. I mean, that's the harder manufacturing. I mean, that their whole entire industry is going to get decimated if they don't get energy costs down.
Well, one thing we haven't talked about is commodity prices. Natural gas, unlike oil, just continues to ratchet higher. I think we're almost back to all-time highs. If not, we're just a sniff below.
Hold on. So are those natural gas prices that just are you talking Europe?
Excuse me. Very important distinction. Sorry, I screwed that up. Very, very important distinction. The natural gas prices in Europe, not in the US.
Because here in BC, man, I'm running my gas fireplace every day, even in the summer.
Well, you drive a Tesla, so it's okay. But I know that I'm looking at it right now. So there's like thing called the Tidal Transfer Facility in Netherlands, the TTF. You can Google it if you want. And it's just below the all-time high, which was in like February, right when Russia tried to liberate Ukraine. and yeah, it's not even the winter, right? So let's just remember, this is always very seasonal. Like natural gas, lots of commodity prices are seasonal, depending on what commodity, whether it's metal or grain or gas or oil or whatever it is. Loads of economic series are seasonal, and natural gas is just like every other one. But we're in the middle of the summer, at the end of the summer, and we're about to crack the all-time high in euros per megawatt hour in Netherlands, Europe, and the UK. Whereas the Henry Hub is still at 29 euros per megawatt hour. So they're in trouble.
So guys, this brings us to like the biggest global macro risk event that we have coming up, and everyone is aware of it. And what we're talking about here is, is effectively Europe getting cut off from energy this winter. And this is what I'm trying to reconcile as an investment manager, because once everyone is aware of a risk, as you mentioned, Rich, politically, they're trying to come to a solution. How do we fix this? And the clock is ticking on it, of course. So I guess November-ish, they're really going to start needing more energy coming through. But yet markets are not, even though nat gas price is going up in Europe is not crumbling. Like, it's not there yet. And the closer we get to this event from happening, it increases the probability that, it could be this enormous risk off event. But even the fact that like everyone is aware of this now, if you're following markets closely, and yet there's no market reaction from it. And if it does, for example, euro will go down to 80 cents. That's what we're looking at here. The banking sector will come down pretty aggressively. The ECB will have to try to do yield curve control, and that's what they'll want to do. But like, it's coming. We're months away. Yeah, we're months away from the event, And I know right now, like we're talking about, hey, early September with the, the Western world central banks coming out and everything, but we still have this huge energy, crisis about to hit the Europeans. So for that reason, I'm under the belief that it won't happen. There is a solution here somewhere.
Yeah,
the
burning
Europeans
coal.
But the Europeans are very clever at changing their political stride, to meet their own needs. But I'm not sure if they're going to be able to change it enough to meet this. Anyway, it's just something that, I don't know the answer to this yet. I don't know the solution.
I'm sure it's nothing the ECB can't fix.
You think?
What fixes gas prices? QE.
But you're right. You're right, Keith, in the sense that it's, if you look at the IFO, so, we often talk about the ISM, which is the Institute of Supply Management, which is the US kind of manufacturing survey or services survey. And in Germany, you have the IFO. I don't know what it stands for, but it's the Institute for Economic Research, based out of Munich. They do a similar survey. They ask you, are you happy? Are you sad? Are you hiring? Are you firing? Are you investing or not investing, et cetera, et cetera. And that series for Germany continues to fall. And it's basically at the lows, almost at the lows of the pandemic. So March or whatever, April of 2020. And so you have to take that number seriously, in the sense that the expectations for the German manufacturing sector, the German industrial base, is terrible. I mean, it is, in effect, if it's not in a recession, it will be. Do you know what I mean? Like, these numbers are so bad that you're right, Keith. I think it's wild in a way that the market's hasn't quite either priced it in. Maybe they're just assuming that things will get better. I don't know. I can't figure it out. This is something that I've.
Yeah, here's another thing to think about, and we're pretty good at seeing the big picture before anyone else sees it. So I'm announcing this for the first.
Thank you.
Well, I meant Ice Cap. I said we, not Loonie Hour. Certainly not Steve. There, Steve is asleep against the wall.
Yeah, I don't even know what's going on.
Yeah. What was I saying? Oh yeah, how smart we are. The what's going to happen now this winter? We have the World Cup of Soccer taking place. Instead of it being a summer event, it's now a winter event. It's down in Qatar or Qatar or whatever your fancy is with it. And so if you got the World Cup taking place in the winter in Germany, and all the lads are out all the time and this, and then you're getting this energy crisis hitting at the same time. All of a sudden, you got all the locals gathered in one place, and it has the opportunity to really creating some domestic challenges up there. So and it could be on the other side as well. So with Germany, I don't know what their football team will be like at this tournament.
It's probably going to be good.
Yeah, they usually are. Like, what's the definition of soccer? Each team has 11 players and one ball. 90 minutes later, the Germans win.
You gotta explain this joke too.
0 for 2.
0 for 2. I think that's a good place to wrap it up too. I'm sick of hearing these jokes.
Everyone knows
I can't take
that
another one.
joke. You don't get it.
No.
What happened to the good old days with a good boomer story? We're tapping out, but I will give you here. You guys want to? Here's a good joke to end the show. The governor of the Bank of Canada has recently been telling employers not to give pay raises to Canadian workers because of inflation. Yet the Bank of Canada gave itself $45 million in raises and bonuses over the course of the pandemic for actually, and of course, I don't think they did a very good job at their job, of course, by managing inflation. So the irony there is, of course, this follows the UK, the Bank of England's governor, who was also telling several large companies to not provide juicy raises for the plebes. So we'll leave it there. Rather ironic, of course, but as always, we appreciate your guys' support. All we ask that you continue to share this episode with at least one friend, one family member. Give us the 5-star review on Spotify, Apple Podcasts. Help us beat Arrive Can. We'll get there. It's going to take a couple of years, but we'll get there. God bless. We'll see you next week.